What's up, shipmates? Check it out.
It's my boat.
That's right, that's my boat. That's the USS John C. Stennis CVN-74. It's an aircraft carrier that I spent a good chunk of my younger years on. So I'm excited to share with you this portfolio update because I had a bunch of sales that we'll get into. Have another stock that I'm going for the Century Club on, adding 100 shares, or I'm getting to 100 shares. Now we're also going to hit the portfolio's top winners and losers, and we're going to start it off with the August dividends. So in August of 2022, we received $360.47 in dividends, $1.53 of interest from cash just hanging around the accounts, waiting to be deployed and put to good use. So we got a total of $362 of dividends and interest in August. So instead of going through these line by line, because we'll be here all night, I'm going to throw these up on the screen. No, I'm not going to throw up. We're going to put them up on the screen starting here with the Roth. We're on the same day of August 19th. I bought 3 shares of ticker EPD, Enterprise Products Partners. Loving the oil stuff. I think it's going to be hanging around for a while. We got to transport oil. That's what EPD does. And I'm going to keep buying more. By the way, they are a limited partnership, meaning that you will have to pay not only the ordinary income taxes on those, but you will also receive a Schedule K-1, which is a bit of a pain in the butt at tax time. So if you hold those in a retirement account and your dividend income is less than $1,000 of those limited partnership, you're not going to pay or have to file a K-1 on that or pay any additional taxes, even if they're in a retirement account. And then everybody knows them and loves them. 3 shares of Verizon. Why? Because they were $44, which they eventually did fall a few bucks further. And then shifting on over to the self-directed IRA, we'll just run through these. Bought some couple tranches of Store Capital, ticker STOR, 7 shares there in the high $28 range. Sold 7, now I had 107 shares of Omega Healthcare Investors, ticker OHI, which click at the end of the video. I'll have the little box next to my head. 7 shares I sold on August 10th. Bought 2 more shares of Store Capital on the 17th. And then on August 19th, I had that covered call that was indeed exercised for $33 a share. So I got $3,300 for OHI. Bought some more Store, went back to the store. I'm really trying to build them up. And then I bought another share of URNM, the Sprott Uranium Miners ETF, because I think uranium is the energy of the future. It's clean, it's green, it's emission reduced energy that the world is going to need. So I really would like this to come back down. It's kind of gotten a little bit ahead of itself, but URNM, not advice, just my opinion here on URNM. Bought more Store at $27.59. Again, these are all at degrin.com. Go to dapperdividends.com to access that. Click on the My Portfolio tab. Portfolio. JPM, I had a cash secured put that was exercised on August 26th. 100 shares of good old JP Morgan Chase. Intel. Dipped my toe with Intel at $32.25 a share. Of course, it fell a few more bucks after I bought, but I think they're a good turnaround play. You've heard me say it that chip cycles take about 3 to 5 years to complete. Pat Gelsinger, who was the former chief technical officer, has only been at the helm as CEO for I think 18, almost 19 months now. So I think we need to give him a little bit more time for his machinations to play out. And then wrapped it all up with a few more shares of Store Capital at $26.96 because it's dropping, and at the beginning of the month, you see I bought it at $28.85. There's a whole lot going on here in the Taxable Bridge account, and it's mostly Cisco. You can see I've got a bunch of Cisco I've been buying. Well, a lot of that money I've been consolidating ancillary positions. It's kind of been my jam that I'm going to. Companies that I was down on didn't have a really big position. I've been selling them off to get cash to consolidate into a company that I can get to 100 shares and put in the wheel, which I've pegged that as Cisco. So first you can see here, really interesting, on August 1st, I bought Merck, ticker MRK. Hold that thought in your head. I bought them at $88.66. Now I did sell Advanced Auto Parts, ticker AAP. And I sold Advanced because while we see that they have a dividend safety score of very safe 89, there's a few things with Advanced that have made me nervous. I mean, their dividend growth has been just phenomenal, but check that out. It's basically been flat, and then all of a sudden, they just started increasing it in 2020 and 2021. 50% last increase, 68%. This is kind of untenable. I think for increases that continue like that, $6 per share they're currently paying out. Their dividend yield is currently 517% above the 5-year average of 0.54. And the PE is below the 5-year average, so they look to be on sale. But look at here, the free cash flow payout ratio, 113%, when historically, all the way up until even 2020, they were at 10%. Now they're at 113%. That can't last. Something's going to have to change. And that's because their free cash flow per share has really dropped off the last 12 months. So I don't know if management made a miscalculation, but I don't like to see that. Sales growth only 2%, down from 9%. So I think they're definitely hitting some headwinds here. And yes, while they've reduced their shares to 62.3 billion, their total sales are still at 11.1 billion, so that is at least nice to see. Not thrilled that their free cash flow margin is only 2%, and they're having issues right now. So you know what? I took a small little loss on Advanced Auto Parts for tax loss harvesting purposes. And then right here, their net debt currently 58%, up from 43% in 2020. And then this is kind of funny. So on August 2nd and August 4th, I bought Merck at 88 and 87, 3 shares and 2 shares. But if you look, you'll see on August 12th, I actually sold 14 shares of Merck. So I had wanted to make Merck the Century Club stock that I was going to start building and going into. But what happened was the Inflation Reduction Act, and that's going to give the US government some new interesting authority to negotiate drug prices, which I think is going to lower drug prices. And it's going to, make more volume. There's going to be higher volume for the drug manufacturers. But man, with those lower prices, that might scare some of them off to not really spend that R&D money that they've been spending, which could affect new innovation coming down the pipeline, which could affect new drugs coming out that people want and need, which could affect sales. And it's not really clear which drugs this is going to affect or the scope of it right now. But it's just enough murkiness that I'm going to reduce those shares back to, I think, 10 shares I'm holding of Merck. And I'm going to just keep holding those because I have a good cost basis on those. But if I'm going to be buying healthcare, it's going to be a company that has exposure to at least medical devices and consumer health products like J&J, but that consumer health is going to be spun off. So I did sell those 14 shares of Merck on August 12th after I had a little bit of time to sleep on and digest what's up with this Reflation Induction Act. Did I say Reflation Induction Act? And then it was all Cisco from there, buying almost every day, pretty on the reg. And as it's been dropping down, you could see I bought a few shares at $49. That was their earnings they had right here. Their earnings jumped up. And then I looked at the chart and I knew it was going to come down more likely than not. And it has been coming down. So I've just been adding all the way down on Cisco. So Simply Safe gives them a dividend safety score of 91. And what I do like about Cisco is that if you don't know what they do in a nutshell, they connect computer networks. But as of late, they've been shifting from hardware to software and services, which is really cool because currently about 40% of their revenue is from recurring services. And management has said by September of 2025, they would like to see that over 50%. So I think that's really interesting. They're a bit of a company in transition, but I think they're a strong company and they have a record order backlog. So they definitely don't have a product issue. It's more supply. It's not demand issues with Cisco. And they have a 10-year CAGR of 18%, but that last dividend increase was only 2.7%. But they have an 11-year growth streak, and they're currently paying $1.52 per share. And we'll be going ex-dividend on October October 4th. So as of this video, that's 26 days away. So get on it. Their dividend yield is currently 14% above the 5-year average. And that PE is squarely below the 5-year average, because that's the kind of hard-hitting analysis you get here. 15.2 is greater than 12.8, so it's definitely below. But their free cash flow payout ratio, only 49%. Free cash flow per share dipped a little bit, but it's $3.06. And remember, they're paying $1.52, so they can definitely cover that. Sales growth, 3%. You know, could be better. Reducing shares down to 4.19 billion. Their sales up and to the right at 51.6 billion. Really high return on equity and return on invested capital. Also, free cash flow margin, very nice at 20%. Now, this shows them having no debt, and I should not have been lazy and verified that, but we'll save that for another show. But their interest coverage ratio, according to Simply Safe Dividends, is a whopping $38.91 of operating income for every $1 of interest expense, so they can easily cover that. All right, well, we're going to start with the bad, and we'll see for dividend stocks that I am down the most on ONL, which is the office REIT that Realty Income shat out that I didn't sell right away, so hopefully someday that's going to come back up. I only have 6 shares of that, so no biggie. It's not a big part. Eventually I'll get rid of it. And then IIPR, I do like them. I do think they're going to recover. They do have a 50 borderline safe score, so that's going to be interesting to watch. I don't think I'm going to add any more, but right here at 89 bucks, I think it looks like a good bet. And then of course, Intel, I am down 34.6% on. That is a cash secured put that kind of went awry, and I am seriously considering adding more if it gets into the mid to upper 20s. And then for good measure, you can see I'm down 30% on AT&T, so that's the bad. And now to the good. ADM, Archer Daniels Midland, up 109% on Archer Daniels, up 108% on Exxon Mobil. Energy Transfer, ticker ETM, up 85%, and then Chevron. So interesting that oil is in the top 4. And interestingly, Simply Safe gives Chevron a safety score of 90 and Exxon only 80. If you'd be so kind, we would all love to know what you're buying in the comments below, because you know where the comments go. And in this little box next to my head is OHI. You can find out why I exited OHI and sold out completely. And if you click on that video, I will talk to you there.